Welcome everyone to 912 Financial Group's review of the 912 Playbook, mid-March 2024 featured investor suggestion. Okay, let's review the mid-March suggestion. The Boeing company, we reviewed the chart, did our internal analysis, and decided the risk-reward was there to suggest entering into a bullish position with Boeing at 182.53. We decided that a good place to put a stop was at the end of September 2023 lows and set a target for it to return to where it was trading prior to the recent 737 MAX issue. So our stop is 120.99 and our target is 208.25. So using that information, we produced our trade suggestion. Given where the stock is currently trading and our target and stop, we construct the position of buying a September 185 call, selling a September 210 call, and selling 2 September 145 puts. Why September? Because we are investing, and 6 months is what we target for these investor suggestions. Now, you will notice that the suggestion makes note of a conservative trader. The conservative trader will utilize a stop, while the aggressive trader will not. When you enter this trade, you need to decide if you're willing to take ownership at the short put strike, because that is the risk of the strategy. It may seem counterintuitive, but featured investor suggestions benefit those who are aggressive in their desire to take ownership of the underlying via exposure to the 2 short puts should the underlying take another leg down after application. Because while the conservative trader locks in a loss at the stop due to the increase in short put premium and the decrease in net long call premium, those who hold the position to expiration will benefit from premium decay. They will also benefit from that window of forgiveness between the long call and the short puts, where the position can expire without harm to the trader. There will be daily P&L swings, but the only way the aggressive trader can lose is if the stock closes below the short put strike on expiration, where he now becomes an owner at the level the trader intended to become an investor. It's this large window of forgiveness where we can be wrong and not lose money that makes this strategy unique. As for maintenance for this position, for the conservative trader, it's remarkably simple. Place an OC01 cancels the other, order to close the entire position should Boeing trade either 120.99 or 208.25. Also, have bids to close your short units at 5 cents good until canceled. For the aggressive trader, it's even simpler. Only place an order to close both call units should Boeing trade 208.25. And let the short puts do what they will until you either get them back at 5 cents or they expire in the money and you own the stock. Both would close the long call should it close in the money on expiration day. The conservative trader wants 0 residual position at the end of the life of the trade. The aggressive trader would only have a residual position should they get assigned on the 145 puts prior to closing them at 5 cents. The margin usage should be the margin used to sell 2 September 145 puts. If you would like to reduce the requirement, you can buy further out of the money September puts, the 130s or the 120s, but that would increase the cost of the trade by the cost of 2 of those units. So this is our starting point. Okay, let's see what happened. You put the position on March 18th for a 10-cent credit. At the end of March, Boeing closed at 192.99. Your position closed at a 743 debit. And with the 10-cent credit at entry, you are up $753. At the end of April, Boeing closed at 167.84. Your position closed at a 57-cent debit. And with the 10-cent credit at entry, you're up $67. At the end of May, Boeing closed at 177.61. Your position closed at a 525 debit. And with the 10-cent credit at entry, you're up $535. At the end of June, Boeing closed at 182.01. Your position closed at a 560 debit. And with the 10-cent credit at entry, now you're up $570. At the end of July, Boeing closed at 190.60. Your position closed at an 810 debit. And with the 10-cent credit at entry, now you're up $820. At the end of August, Boeing closed at $173.74. Your position closed at a $1 debit, and with the 10-cent credit at entry, now you're up $110. Going into September expiration, several things occurred for both the conservative and aggressive trader. First, they were able to close the short September 210 call on September 5th for 5 cents. You did the trade for a 10-cent credit. Now your credit has been reduced to 5 cents, but you then had unlimited upside potential instead of capping it at the short call strike. Next, after a bit of time decay, you were able to close the 2 short September 135 puts on September 19th for 5 cents or 10 cents in total, and removed your downside risk. That increased your position cost from a 5-cent credit to a 5-cent debit, and allowed the conservative trader to cancel their downside stop. And what did that leave you? You owned a September 185 call for 5 cents. The most you could lose at that point was $5. The question was, where would Boeing close when the call expires? Unfortunately, Boeing closed at 153.29. Your position closed at 0, and with the 10-cent credit at entry minus the cost of the units you bought back. Both the conservative and aggressive trader lost $5. And here's the lesson to be learned from this trade suggestion. Investing involves looking for good opportunities within the big picture, and good opportunities rarely look good at the time they are presented. The best investing involves initiating ownership when things look bad, identifying value at your entry price, and expecting future improvement in value, not in a day, a week, or even a month. And when we at 912 Financial Group make a featured investor trade suggestion, we operate under the premise that we are 100% okay with, in fact. Or we desire ownership of the stock or index. We are suggesting at the discounted levels that positions would produce should the short puts turn to ownership at their strike price. Sometimes the desire to not lose money costs you more in the end. Fortunately, that wasn't the case this time, as Boeing never got close to the stop for the conservative trader. And in the end, both the conservative trader and the aggressive trader walked away with the same small $5 loss. You basically broke even on a bullish position where the stock was almost $30 lower in the end. That's the beauty of this strategy. You can be wrong and still break even. If you are viewing this review and are still not sure about subscribing, request a free 14-day trial edition at 912financialgroup.com. Thanks for joining me. Contact us with comments or criticism at 912financialgroup.com. Check us out at 912FinGroup on X. Have a great day.